everyone. We had some scrolling slides moments ago that filled you in on the CEs and other important information about these webinars. If you missed that, just visit our education page on our website and it'll be there for you. We welcome you to this month's webinar presentation. It qualifies for 1 CFP CE, but you must stay logged on for 50 or more minutes. You will receive proof of your attendance within a month. As a reminder, this webinar is being recorded and will be posted to our website within just a couple of days. So if you have colleagues who couldn't attend today, please let them know they can view the presentation by next week. Last month, we looked at annuities from a 101 perspective. Today's Annuities 201 presentation is an advanced look at annuities and their writers. If you missed last month, it is again available for viewing on our website. And now for today's presentation. Jerry Skapyak will be leading you through this Annuity 201 presentation. His almost 20 years in the industry analyzing, studying, and researching annuity products have made him the go-to guy for advisors with clients seeking to ensure they don't outlive their savings. He is licensed for life and health insurance products, and, even more important than his product knowledge, Jerry knows people. He is skilled at assessing clients' needs and the benefits that are most important to them, then tailoring the right product to fit their unique circumstances. He's logistical, he's a problem solver, he's a successful leader, and a sought-after speaker, and he's our annuity expert. Jerry, it's time for 201.
Thank you, Dina. Before we get started, I want to talk about the slide that we have up here. We are pleased to introduce a policy created for fee-only financial advisors and their clients by Low Load Services, Keith Maurer, and American General Life Insurance Company. This solution provides guarantees and flexibility in today's uncertain time. This product is ideal for clients who want to leave a legacy. The American General Survivor Advantage GUL guarantees your clients death benefit, premium, access, cash values. To learn more about this innovative product at one of our upcoming webinars, either June 5th or July 24th. And now, on to Annuities 201. What we are going to cover today is we're going to talk about some of the most common questions I get from advisors, and it is the living benefits that are on the annuities your clients either have already purchased or are looking to possibly purchase. Finally, we're going to go over some of the death benefit riders that are available on the annuities. And finally, we are going to look at who should consider these products. So when we're looking at the living benefits, this topic is becoming hotter and hotter as time goes on. Your clients are coming to you with them. They're being proposed these products by the local insurance agent, the teller at the bank. They're seeing them. Their friends have them. They want them. And why do they want them? Because they provide guarantees in these uncertain markets that we are in right now, this roller coaster with the stock market. Clients are looking for guarantees. They want a guaranteed income. They don't want to lose any more money in the market. That's why these products have become so hot lately. So what we're going to do is we're going to look at the 3 most common types of living benefits that are available. We're going to look at a guaranteed lifetime withdrawal benefit, a guaranteed minimum income benefit, and then finally a guaranteed minimum withdrawal benefit. So why are clients purchasing these? Well, first off, most of them, it's been sold to them. Some of them, as I said, are starting to come to you and inquire about these products, but most of them have been sold to the clients. Most clients aren't going out saying, hey, I want to buy an annuity that has a living benefit. But as I said, the clients are wanting these products for the guarantees, whether it's guaranteed growth that they're seeking or guaranteed income. And what we're going to do is we're going to talk about what are these guarantees, what do they mean? Well, the first thing we need to understand is that with these annuities that have these living benefits, there's 2 accounts in the annuity. The first account is the account value, the cash account, the real money. This is the money that they can spend. Then there's a benefit base. It's the funny money. It's like Monopoly money. It's nothing more than a number on the statement. What we're going to do now, and I hope everybody's going to pay attention to this because we're going to go through an example. And we're going to use this example throughout the webinar today. We're going to constantly refer back to it because all of these living benefits on the front part, how values are accumulated, are what is the driving force behind them. And I want to stress this again. If you have any questions throughout the webinar, please type it in on the screen, and we will be addressing them as we go throughout the webinar today. So let's go over our example. Let's say we have a client, and they want to invest $100,000 into an annuity, and they're guaranteed 5%. We're gonna look at what that 5% means. Clients may be coming to you with saying, hey, I got an annuity that's going to guarantee me 6%, 7%, 8%, 10%. There's all different guarantees out there, but they all, for the most part, basically work the same way. So for our client who has $100,000, at the end of year one, their account value is worth $103. We're going to ignore all charges on annuities. Right now, what I want everybody to understand is just how the numbers grow and what they mean. So at the end of year one, our annuity earned 3%. Our account value is worth $103,000. But we're guaranteed 5% growth. Well, it's the benefit base that is guaranteed to grow, not the account value. A lot of clients will come to you and say, well, I was told I'm guaranteed to get 5%. Well, they are guaranteed to get 5% growth, but it's on the benefit base. So at the end of year one, our benefit base is worth $105,000, and our account value is worth $103. Year two, our account value grows to $120,000. Stellar year. Annuity did great. And our benefit base, it's guaranteed to grow at 5%, so it's going to be worth $110,000. But another feature to these annuities is that the annuity has what's called a step-up feature. And what that means is that on any anniversary, in our example, we're going to use policy anniversary. Some annuities do it on a quarterly basis. Some do it monthly. There's even an annuity out there that does it on a daily basis. But for our example, we're going to assume on policy anniversary. And what this step-up does is on the policy anniversary, it's going to look inside the annuity. It's going to say if the account value is greater than the benefit base, it's going to step up to equal. So actually at the end of year two, our benefit base is not the $110,000, but it's actually going to be $120,000. So now year three comes along, and it's 2008 all over again. Stock market takes a plunge, and our account value goes down to $80,000. But we're still guaranteed to get 5% growth on our benefit base, so it's going to be worth $126,000. I have a question here, and it's saying, are you assuming 3% real growth? In year one, we're just assuming 3% growth. We're not taking into account any of the fees. So at the end of year three, we have an account value that's worth $80,000. We have a benefit base that's worth $126,000. We have two numbers here, and the clients like that big number of $126,000, and they want to, you know what, maybe they want to surrender the annuity, maybe they want to start taking income. The numbers each mean something different. But the $126,000, which is what everybody's going to focus on, your clients and as advisors you're going to focus on. You got to remember that $126,000 is not a number that you can surrender the annuity for. It is only used for calculating income. So we're going to move beyond the basics now of these living benefits. The two main types of living benefits that are out there. The first is a guaranteed lifetime withdrawal benefit. And you notice we say no annuitization on it. What it does It allows the client to withdraw money out of the annuity. They are not annuitizing. When you annuitize something, you give up control. And that's actually where we talk about our second living benefit, the Guaranteed Minimum Income Benefit, or GMIB. It has two options. The owner can either withdraw up to 5% of that benefit base for life, no annuitization, or they can annuitize the benefit base for higher income, but they have to give up control of the annuity to do that. So let's take a look. We're going to go into more detail now in this guaranteed lifetime withdrawal benefit. On the low-load annuity that we use here at Low Load Insurance, it has a step-ladder effect like this depending on the age of the first withdrawal. So for example, if the client is 60 years old, they can withdraw 5% for life of that benefit base, actually anywhere between age 60 and 64. If they wait to age 65 to take that first withdrawal, they get 7.5%. Or if they wait to age 70, they get 6%. In our example going forward, I'm going to assume the client waits to age 70 here. So they're going to be able to withdraw 6% for life. So going back to our example, the client's going to start taking withdrawals at age 70. They have an account value that's $80,000 at the end of year 3, and they have a benefit base that's worth equal to $126,000. The client is going to be able to get 6% of that benefit base, so they're going to be able to withdraw $7,560 for life. Now, if the client decides, well, that's not enough, I want to take more than that $7,500, they can do that, but they can't have both. They can't take more than this $77,560 and be guaranteed that for life if they want to dip into the account value. And we're going to go over some examples that explains all this. So let's take a look. We got a little chart I put together here, and we got year 1 through year 20 here, and we're showing our clients going to start taking withdrawals in year 4. They're able to take $7,560, and as you notice, that goes on for life. Next column is just a cumulative of how much they're able to withdraw, and then this is their account value. When the client starts taking withdrawals, and I'm not assuming any additional growth in this, this is just to give you an understanding of what happens with the account values, at the different values in this annuity. As long as the client only takes $7,560 out of this annuity, it's subtracted from the account value. And if we assume no additional growth and no fees for anything, this annuity account value is going to last 13 years to right here. But you notice, even when this account value hits 0, the client is still able to withdraw the $7,560. And you'll notice our benefit base that was $126,000 stays level throughout for the entire time. For as long as this client's alive, they never take more than $7,560 out. This benefit base is guaranteed to stay level, and they're guaranteed to get the $7,560. But when your clients are sold these annuities, this living benefit, the guaranteed lifetime withdrawal benefit, they're told they have access to their account value. And that is absolutely true. The client always has access to that account value. But what happens if the client withdraws more than their lifetime withdrawal percentage, or more than they're able to take? So when we go to our example, the client at the end of year 3 had an account value of $80,000, and they have a benefit base of $126,000. But the client decides in year 4 that, you know what, I want to take $40,000 out, and I want to go buy a new car. And they can do that. We're ignoring surrender charges on the annuity, but if they are with a low-load annuity, there are no surrender charges with that product. So they could take $40,000 free of any surrender penalties. But with these benefits, any excess withdrawals are proportional to the account value and benefit base. So in our example here, the client's going to withdraw 50% of his account value. So what that's going to do is it's going to reduce the account value down to $40,000 and reduce